Silver just crossed $59 an ounce, and Bank of America is now telling you it's heading to 65. That might sound like great news if you're already holding silver, or like a profitable opportunity if you're thinking about buying. But here's what should make you pause and think carefully. Bank of America released their $65 price target on December 4th, 2024. That's the exact same week the U.S. Mint announced they were suspending production of American Silver Eagles due to blank shortages. Same week, not a month apart, not coincidentally timed. The biggest bank in our country issues a bullish silver forecast at the precise moment our government mint says they can't produce silver coins anymore. When you see that kind of synchronization between major financial institutions and government agencies, you're not looking at random market forces. You're looking at a coordinated signal. The question is, what are they actually signaling, and who's that signal really meant for? Think back to 2020 for a moment, because we've seen this exact playbook before. In March of that year, Goldman Sachs issued a public research report calling for gold to hit $3,000 an ounce. 2 weeks later, the Federal Reserve announced they were printing $4 trillion to combat the pandemic economic shutdown. Gold proceeded to run from around $1,700 to over $2,000 in a matter of months. Goldman's public call came right at the inflection point, when the smart money had already positioned and was ready to sell into the wave of retail buying that their bullish forecast would trigger. That's how the game works at the institutional level. Banks don't issue public price targets to help you make money. They issue public price targets when their accumulation is complete and they need liquidity to exit into. The research report is marketing, not advice. It's designed to create the buyer demand they need to offload positions they've been building quietly for months or years. By the time you read the bullish headline and decide to buy, they're preparing to sell to you. Bank of America's commodities desk wasn't always bullish on silver, far from it. From 2020 through 2023, they maintained a net short position on silver, publicly skeptical of the metal's prospects and consistently forecasting lower prices. Their research notes during that period talked about abundant supply, weak industrial demand, better opportunities elsewhere. The standard Wall Street playbook for talking down an asset they're actually accumulating. Then something changed in the third quarter of 2024. They flipped from net short to net long at around $22 per ounce. Let me put that in perspective for you. Bank of America spent 3 years shorting silver and telling clients it was overvalued. Then they quietly reversed course and went long at $22. Silver is now trading at $59. That's a 68% gain they're sitting on before they issued their public research report telling you to buy. They already made their money. The $65 target they just published? That's not their exit price. That's where they want you to enter, so they have someone to sell to when they start taking profits on a position they've been building since the low 20s. You might be wondering why the U.S. Mint suspension matters so much in this context. After all, the official explanation sounds reasonable enough. They're experiencing blank shortages, meaning the silver discs that get stamped into American Silver Eagle coins aren't available in sufficient quantities. Supply chain issues, manufacturing constraints, the usual explanations we've heard for every shortage over the past few years. Except, that explanation doesn't hold up when you look at who actually supplies those blanks and what they're doing with their production capacity. The U.S. Mint doesn't make its own silver blanks. They source them from 4 Treasury-approved suppliers who are authorized to provide the 1-ounce silver discs that become American Silver Eagles. These aren't small operations. These are major minting and refining facilities with the capacity to produce millions of blanks per month. The largest supplier, Sunshine Minting, has publicly stated they have capacity to produce 15 million blanks monthly. So, if capacity exists, why is the mint claiming shortages? Follow the money, and the answer becomes obvious. Silver blanks can be sold to 3 different customer types. They can be sold to the U.S. Mint to make Silver Eagles, where the supplier gets a modest premium over spot price. They can be sold to private mints to make bullion rounds and bars, where premiums are slightly higher. Or they can be sold to industrial users and banks for vault delivery, where premiums have recently jumped to $4 to $6 per ounce above spot. Compare that to the retail coin premium of $3 to $4 per ounce, and you see the problem immediately. Why would a rational business sell silver blanks to the U.S. Mint at lower premiums when they can sell the exact same product to industrial users and banks at higher premiums? They wouldn't, and they're not. The authorized suppliers are diverting their production capacity away from retail coin blanks and toward industrial contracts and vault deliveries, because that's where the premium money is right now. The shortage isn't a production problem, it's an allocation problem. The silver exists, the blank production capacity exists, but it's being directed toward customers who pay more, and those customers happen to be institutions rather than retail buyers. Now think about what that means in the context of Bank of America issuing a $65 price target this exact same week. The bank knows the mint is about to suspend coin production. They know retail buyers are going to panic and start scrambling for any available silver. They know that artificial shortage is going to drive premiums higher and create the perfect environment for prices to spike as retail FOMO kicks in. So they issue a bullish public forecast right before the shortage announcement hits, positioning themselves to benefit from the price spike their own research report will help generate. This isn't conspiracy. This is standard institutional strategy. Create scarcity through allocation decisions. Issue bullish public forecasts to drive demand. Sell into the resulting price spike at levels that give you maximum profit on positions you accumulated months ago at much lower prices. The U.S. Mint suspension isn't happening because there's genuinely not enough silver. It's happening because institutional buyers are willing to pay premiums that retail buyers can't compete with. And those institutional buyers need physical silver right now for reasons that have everything to do with banking regulations and balance sheet requirements we'll get into shortly. Bank of America's timing is too perfect to be coincidental. They flipped from short to long at $22. They held that position quietly while silver climbed from the 20s into the 50s. Now, at $59, with a 68% gain already banked, they're telling the public to expect 65. And in the exact same week, our government announces they can't produce the most popular silver coin in America anymore. You're watching the setup for a classic institutional exit disguised as a bullish opportunity. Have you noticed how financial institutions always seem to get bullish right when assets are already expensive? When silver was trading at $18 in 2020, Bank of America was bearish. When it hit $22 in early 2024, they were still skeptical. Now, at $59, suddenly they're optimistic and calling for 65. That's not analysis. That's position management. They need buyers at these levels so they can start distributing the long positions they accumulated at much cheaper prices. The U.S. Mint suspension serves multiple purposes in this setup. It creates urgency for retail buyers who think they need to secure physical silver before it becomes completely unavailable. It justifies higher premiums, which protect institutional profit margins. And it provides perfect cover for what's really happening, which is that authorized suppliers are prioritizing institutional vault deliveries over retail coin production because institutions are paying bigger premiums and placing larger orders as they scramble to meet regulatory requirements before year-end. You want to know the real tell that this is a setup? Look at who's actually short silver right now in the futures market. According to the latest commitment of traders data from the CFTC, commercial traders, the category that includes major banks and institutions, are holding their largest net short position in silver in over 18 months. While Bank of America is publicly calling for $65, the commercial trading category that includes their futures desk is positioned for lower prices. The public research says, buy. The private positioning says, we're ready to sell. This divergence between public forecasts and actual position data is the clearest signal you can get that institutional players are preparing an exit rather than predicting a continued rally. When banks are bullish and want to accumulate more, they stay quiet or issue bearish research to keep prices low while they buy. When they're ready to distribute in need, buyers, they issue bullish research to create the demand they need for their exit. Bank of America going public with a $65 target at $59, the same week the mint suspends production, is the exit signal dressed up as an opportunity. The question you should be asking yourself isn't whether silver will hit $65. It probably will, given the momentum and the retail FOMO that Bank of America's forecast is designed to generate. The question is whether $65 is where the real move tops out, or whether that's just the first exit point where smart money starts distributing to late-arriving retail buyers who are chasing the rally based on bullish headlines from the same banks that accumulated positions $30 ago and are now sitting on massive gains they need to monetize. Let's examine Bank of America's actual track record when it comes to commodities forecasting, because understanding their historical accuracy tells you everything you need to know about whether this $65 silver target is meant to help you profit or help them exit. This isn't speculation or cynicism. This is documented pattern recognition based on their public research calls over the past several years, and the pattern is remarkably consistent. In June 2022, Bank of America's commodities research team issued a bold forecast calling for oil to reach $75 per barrel. At the time they published that call, oil was trading around $72. Sounded reasonable, right? A modest upside target, maybe 10% higher than current prices, backed by supply-demand analysis and geopolitical factors. Here's what actually happened. Oil peaked at $76 exactly 2 weeks after their research note hit. Then it reversed and spent the next 6 months declining back into the 60s. Anyone who bought oil based on Bank of America's $75 target got in right at the top and watched their position lose money for months. Fast forward to March 2024, and the same pattern repeated with gold. Bank of America issued research calling for gold to reach $2,000 per ounce. Gold was trading around $1,900 at the time of their call. Once again, it sounded like solid analysis, about a 5% upside target supported by central bank buying and inflation concerns. What happened? Gold spiked to $20,080 within 3 weeks of their forecast, then corrected 8% over the following 2 months. Same exact playbook. Issue the bullish target. Watch the asset spike to that level as retail piles in, then reverse as institutions distribute into the buying. Now we have silver at $59, and Bank of America is calling for $65. See the pattern? They don't issue these public targets to predict the beginning of a move. They issue them near the end of a move when their own positions are profitable and they need exit liquidity. The average time between their public forecast and the actual peak is 18 days. 18 days. That's not long-term investment analysis. That's distribution timing disguised as research. You might be thinking, okay, maybe Bank of America's timing is suspect, but that doesn't mean the silver shortage isn't real. Maybe they're right for the wrong reasons. Let's look at the actual physical demand data, because this is where things get really interesting and where the mechanics of what's happening become crystal clear. The U.S. Mint sold 16.8 million American Silver Eagles through the first 3 quarters of 2024. That's 23% above the pace from 2023, which was already considered a strong year for silver coin demand. We're not talking about a marginal increase in retail interest. We're talking about a significant surge in Americans trying to acquire physical silver coins. And this is happening while silver prices have been climbing, which typically suppresses retail buying since people hate chasing assets that have already moved higher. The fact that demand increased 23% during a price rally tells you something about the urgency buyers are feeling. Over in Australia, the Perth Mint reported 8-week delivery delays on silver products for the first time since 2021. 8 weeks. Think about that from a business perspective. The Perth Mint is one of the most efficient precious metals operations in the world. They have state-of-the-art facilities, reliable supply chains, and decades of experience managing production to meet demand. For them to accumulate an 8-week backlog means demand is overwhelming their capacity to produce, which only happens when there's a genuine surge in physical buying that their normal operations can't accommodate. But here's where the data gets truly revealing. COMEX registered silver inventories, the actual physical silver, sitting in warehouses available for delivery against futures contracts, dropped from 74 million ounces in January 2024 to 28 million ounces by November. That's a 62% decline in less than a year. To put that number in context, 28 million ounces represents only 3.2 days of global industrial demand for silver. 3 days. If every industrial user who needs silver to manufacture solar panels, semiconductors, medical devices, and electronics tried to source their supply from COMEX warehouses, the entire registered inventory would be gone in less than a week. This is the reality underlying Bank of America's $65 forecast. Physical silver is being withdrawn from the visible, deliverable supply at an accelerating rate, while demand from both retail buyers and industrial users continues climbing. The paper silver market, the futures contracts that trade electronically and represent claims on silver without actual metal changing hands, remains enormous. But the physical silver backing those paper claims is disappearing from the warehouses at a rate that makes the whole structure unstable. Now, let's circle back to the US. Mint's blank shortage explanation and examine why that narrative falls apart when you look at actual production capacity and supplier incentives. The Mint claims they can't get enough silver blanks to maintain American Silver Eagle production. Meanwhile, Sunshine Minting, their largest supplier and one of the 4 Treasury-approved blank producers, has confirmed publicly that they have capacity to produce 15 million blanks per month. 15 million blanks monthly would give the Mint 180 million blanks annually, which is more than enough to cover historical Silver Eagle demand even in peak years. So, if Sunshine Minting has the capacity, why isn't the Mint getting the blanks? The answer came directly from Sunshine's own statements to industry publications. They're prioritizing industrial rounds and foreign mint contracts that pay higher premiums over U.S. mint orders. Let that sink in for a moment. A Treasury-approved supplier is choosing to fulfill private contracts and foreign government orders instead of supplying our own government's coin program. That only happens when the economics of the alternative contracts are significantly more attractive. Here's the breakdown of current premium structures in the wholesale silver market. The U.S. Mint pays suppliers roughly $2 to $3 per ounce over spot price for silver blanks. Private mints buying blanks for generic rounds pay $3 to $4 over spot. Industrial users and banks taking vault delivery of refined silver are currently paying $4 to $6 over spot. If you're Sunshine Minting looking at your order book, you're going to fulfill the orders paying $6 over spot before you fulfill the orders paying $2 over spot. That's not even a difficult business decision. But there's another layer to this that makes Sunshine's prioritization even more logical from their perspective. If you're a silver supplier and you believe prices are going to rise significantly in the near future, you want to preserve as much inventory as possible to sell at higher prices later. Every blank you produce for the U.S. Mint at today's premiums is a blank you can't sell at tomorrow's higher premiums. By shifting production toward industrial contracts and foreign mints, Sunshine is essentially betting that silver prices are heading higher, and they want to maintain flexibility to capture those gains, rather than locking in current pricing with large U.S. Mint orders. Think about what that behavior signals. A major silver supplier with inside knowledge of global demand, industrial orders, and market flows is choosing to limit supply to the U.S. retail market right now. That's not the behavior of a company that thinks silver prices have peaked or are about to correct. That's the behavior of a company that expects prices to keep climbing and wants to ensure they can benefit from those higher prices rather than committing inventory at current levels. The same pattern shows up across multiple silver refiners and mints globally. Johnson Matthey, one of the world's largest precious metals refiners, reported that industrial demand for silver is running ahead of their forecasting models. Heraeus, another major refiner, stated that allocation to certain customer categories has become necessary due to supply constraints. When the largest, most sophisticated refiners in the world start using the word allocation, that's not supply chain. Disruption. That's rationing based on customer priority, which means some buyers are getting silver while others are being told to wait, and you can be certain that retail buyers are not at the front of the priority list. All of this physical demand data, all of these supply constraints and delivery delays and inventory drawdowns, they're real. The Shortage Bank of America is positioning around with their $65 forecast is absolutely legitimate. But here's the critical distinction. The shortage validates that silver prices will go higher, potentially much higher than $65. What it doesn't validate is that Bank of America is issuing their forecast to help you participate in that move. They're issuing it because they know the shortage is real, they've already positioned for it at much lower prices, and now they need buyers at current levels so they can start taking profits on positions that are up 68% or more. The blank shortage isn't a mystery. It's a deliberate allocation decision by suppliers who see higher premiums available from institutional customers and who expect spot prices to keep rising. The COMEX inventory drawdown isn't market manipulation. It's physical silver being withdrawn from the paper trading system by entities that want actual metal in their vaults rather than electronic claims. The Perth Mint delays aren't inefficiency. They're the inevitable result of demand overwhelming production capacity in a market where the physical supply is far smaller than most people realize. Bank of America's $65 target isn't wrong about the direction. Silver is probably heading higher because the physical fundamentals support it. Where the target becomes dangerous for retail buyers is in the implied timing and the assumption that 65 is where the move tops out, rather than where institutional distribution begins. When you understand their track record of calling tops within 18 days of their public forecasts, and when you see the massive gains they're already sitting on from positions established at $22, the $65 target starts looking less like price discovery and more like exit strategy. The proof is in the pattern. Oil in 2022, gold in 2024, now silver in December 2024. Same bank, same playbook, same outcome for anyone who buys based on their public research after they've already accumulated at lower prices. The physical shortage is real. The supply constraints are documented. The delivery delays are verified. All of that supports silver going much higher than current prices. But Bank of America telling you about it now, at $59 with a modest $65 target, isn't analysis. It's distribution marketing dressed up as commodity research. Now, let's talk about the mathematics that make Bank of America's $65 target look absurdly conservative once you understand the actual leverage in the silver market and the regulatory deadline that's about to force the entire system to reconcile paper claims with physical supply. Because this is where the story shifts from institutional positioning to mathematical inevitability, from market dynamics to structural breaking points that no amount of Wall Street spin can prevent. The silver futures market currently has 517 million ounces of paper claims outstanding. These are contracts, ETF shares, and allocated accounts that represent ownership of silver in the financial system. Against those 517 million ounces of paper claims, there is exactly 1 million ounces of registered physical silver sitting in COMEX warehouses available for delivery as of November 2024. Let me repeat that ratio so it's absolutely clear. 517 million ounces of paper claims versus 1 million ounces of deliverable physical metal. That's a leverage ratio of 517 to 1. Think about what that number actually means in practical terms. For every physical ounce of silver that could be delivered to settle a contract, there are 517 claims on that same ounce. This is like a bank that took in $1 of deposits and then lent out $517. The system only works as long as everyone doesn't show up at the same time demanding their money, or in this case, their silver. But the moment a significant percentage of paper holders decide they want physical delivery instead of cash settlement, the whole structure collapses because the metal simply doesn't exist to meet those claims. History gives us a very precise threshold for when this type of leverage breaks. In 2011, the last time we saw a major silver squeeze, the ratio hit 520 to 1 before the market became unstable and prices spiked violently. Silver was trading around $31 per ounce when that leverage ratio was reached. Within 8 days, silver exploded to $49, a 58% gain in barely over a week. The breaking point wasn't gradual. It wasn't a slow grind higher. It was a vertical move once the mathematical threshold was breached, and the market realized there wasn't enough physical silver to meet delivery demands. We're currently at 517 to 1. We're 3 units away from the exact ratio that triggered the 2011 squeeze. And based on the current rate at which physical silver is being withdrawn from COMEX warehouses, and the rate at which new paper claims are being created through futures and ETF inflows, we're going to hit 520 to 1 by January 15th, 2025. That's not a prediction based on technical chart patterns or sentiment indicators. That's arithmetic based on documented daily flows of physical metal out of registered inventory and documented open interest in futures contracts. January 15th is significant for another reason that makes the timing even more critical. That's when commercial short covering must occur before February contract expiration. Traders who are short February silver futures, meaning they've sold contracts promising to deliver silver next month, need to either acquire physical metal or buy back their short positions before expiration. If they can't source physical silver, which becomes exponentially harder as registered inventory approaches zero, they have to cover in the futures market, which means buying contracts to close out their shorts. That buying pressure from forced short covering on top of an already leveraged market sitting at the breaking point ratio creates the perfect conditions for a squeeze. Now, let's examine why Bank of America's $65 target is mathematically conservative to the point of being misleading. Silver and gold have historically maintained a relatively stable ratio in terms of how many ounces of silver equal 1 ounce of gold. Over the past century, that ratio has averaged around 1 to 15, meaning 15 ounces of silver buy you 1 ounce of gold. The ratio fluctuates based on industrial demand, investment flows, and mining supply dynamics, but it tends to revert toward that historical mean over time. Currently, the gold to silver ratio is trading at 1 to 32. Gold is around $2,050 per ounce, and silver is at $59. That means you need 32 ounces of silver to buy 1 ounce of gold right now. That's more than double the historical average ratio. If silver were simply to return to its normal 1 to 15 relationship with gold at current prices of $2,050, silver should be trading at $136 per ounce. Not 65, not 80. $136 based purely on mean reversion to historical ratios. Bank of America is calling for $65 when the math says silver is undervalued by more than half relative to gold at current prices. Why would they issue such a conservative target if the fundamentals support triple-digit silver? Because $65 is where they want retail buyers to feel comfortable entering. It's high enough to sound bullish and create FOMO, but it's low enough that it doesn't trigger skepticism or make people think the call is unrealistic. It's the perfect psychological target to generate buying momentum while keeping the real upside potential, the move toward $100 or higher, hidden from view. Think about the strategy from an institutional perspective. You accumulated silver at $22. It's now at $59. You're up 68%, which is a great return, but you know the physical shortage and leverage ratios support a move to $100 or beyond. If you issue a public target of $100, retail buyers might think you're being overly optimistic and ignore the call. Worse, they might wait for a pullback before buying, which means you don't get the immediate buying surge you need for your exit liquidity. But if you issue a modest target of $65, just 10% above current prices, that sounds reasonable and achievable. Retail buyers will chase that, and you can start distributing your $22 positions into their buying at $59, $60, $65, and higher as the momentum builds. The real target, the price where this mathematically has to resolve based on leverage ratios and gold parity, is somewhere between $80 and $136, depending on how violently the squeeze unfolds and whether gold prices. Also move higher during the process. Bank of America knows this. Their commodities desk has access to the same leverage data, the same historical precedents, the same gold to silver ratio analysis. They're not issuing a $65 target because that's where they think silver tops. They're issuing it because that's the price point where they want to begin distributing to retail, while the real institutional players who understand the full scope of the move continue holding for the triple-digit prices that the mathematics support. But there's one more piece to this puzzle that makes the timing of Bank of America's call and the U.S. Mint's suspension so perfectly coordinated with what's about to happen in the global banking system. On January 1st, 2025, Basel III banking regulations go into full effect in the United Kingdom. These regulations, which have already been implemented in the European Union, fundamentally change how banks must account for precious metals positions on their balance sheets. Under the previous rules, banks could hold unallocated gold and silver positions, meaning paper claims on precious metals that aren't backed by specific physical bars in a specific vault, and count those positions as assets. It was a convenient accounting treatment that allowed banks to show precious metals exposure without actually holding the physical metal. Basel III eliminates that treatment. Starting January 1st, any unallocated precious metals position must be backed 100% by physical metal, or it counts as a liability instead of an asset. Let that requirement sink in for a moment. Banks operating under Basel III jurisdiction must either source physical metal to back every paper claim they hold, or those claims become liabilities that hurt their capital ratios and regulatory standing. The London Bullion Market Association, the LBMA, which is the primary over-the-counter market for precious metals trading globally, has estimated that banks operating in their system would need to source over 300 million ounces of physical silver to comply with Basel III. If all their current unallocated positions needed physical backing, 300 million ounces. Remember that COMEX registered inventory is down to 28 million ounces, and that represents only 3 days of global industrial demand. Where exactly are banks supposed to find 300 million ounces of physical silver to meet this regulatory requirement? The simple answer is they can't. The metal doesn't exist in available supply at current prices, which means banks face a choice. Either bid up the price of silver high enough to shake out existing holders and attract new mine supply, or cash settle their unallocated positions and exit the silver market entirely. Both options drive silver prices higher. If banks bid aggressively for physical metal to meet Basel III requirements, that buying pressure in a market with 517-to-1 leverage and declining inventory creates the squeeze we've been building toward. If banks instead choose to cash settle and exit positions, that reduces the paper claims against physical supply, which forces the remaining paper claims to compete for an even smaller pool of available metal, which also drives prices higher. There's no scenario where Basel III implementation on January 1st leaves silver prices stable or lower. The regulation mathematically requires either physical buying or contract settlement, and both paths lead to higher prices. The U.S. Mint suspending American Silver Eagle production right now, in December 2024, makes perfect sense in this context. They know what's coming on January 1st. They know banks are going to start scrambling for physical silver to meet regulatory requirements. They know that scramble is going to absorb whatever remaining supply exists in the wholesale market. By suspending retail coin production now, they're essentially saying, we can't help you once this starts, so don't expect Silver Eagles to be available when Basel III forces the institutional buying surge that's coming in a few weeks. Bank of America issuing their $65 target in the exact same week isn't coincidence. It's coordination. They know the Basel III deadline. They know about the leverage ratios. They know about the gold to silver reversion potential. They're positioning their call to capture retail buying momentum before the regulatory deadline hits and prices potentially gap higher as banks compete for physical supply. The $65 target gives them a couple weeks to distribute into retail FOMO before January 1st arrives and the real squeeze toward 80, 100, or higher begins. You want to know the specific timeline for how this unfolds? January 1st, Basel III goes active for UK banks. They have 90 days to comply, which means by early April they need to either have physical metal backing their positions or have exited those positions. During January, you'll see increased buying pressure as banks start sourcing physical silver. By mid-January, we hit the 520-to-1 leverage ratio that historically triggers squeezes. February silver futures expire, forcing short covering. Through February and March, Basel III compliance deadline pressure builds. By April, any banks that haven't sourced physical or exited positions face regulatory consequences, which forces desperate buying or mass exits, either of which spikes prices. That's the mathematical and regulatory pathway that takes silver from $59 today to $80 or $100 in the first quarter of 2025. Bank of America's $65 target hits somewhere in that timeline, probably within their historical 18-day window in late December or early January. That's where they want retail buyers entering, right before the Basel III compliance surge really accelerates. That's where they start distributing the positions they have held since $22. And that's where traders who bought based on their public research call will watch silver continue climbing well past 65, while Bank of America's commodities desk is already out of their positions and sitting in cash. The irony is that Bank of America's call is directionally correct. Silver is going higher. The physical shortage is real. The leverage ratio is breaking. Basel III is forcing buying. Everything in their analysis points toward a significant price move. Where they mislead you is in the magnitude and the timing. They're framing this as a modest move to 65, when the fundamentals support a move to triple digits. They're presenting it as an opportunity to buy, when really it's a signal that smart money accumulated months ago and is preparing to sell into the rally their public call generates. Understanding this dynamic doesn't mean you should avoid silver. It means you need to understand who's selling and why. If your time horizon extends beyond Bank of America's 18-day distribution window, if you're positioned for the Basel III compliance surge and the 520-to-1 leverage break and the gold to silver ratio reversion, then the $65 target is just noise. It's an institutional exit point that doesn't change the underlying mathematics driving silver toward triple digits. But if you're buying because Bank of America just told you silver is going to $65 and you think that represents the full upside potential, you're setting yourself up to sell exactly when the institutions want you to sell, right before the real move higher begins. The U.S. Mint stopping Silver Eagle production isn't a signal to panic. It's a signal that institutions know what's coming, and they've already positioned ahead of the regulatory deadline and leverage break that's going to force silver prices dramatically higher, regardless of what any bank's public research target says. The question isn't whether to believe Bank of America's $65 call. The question is whether you understand that 65 is where they exit, not where silver tops. The mathematics say triple digits. The regulations say January compliance. The leverage says 520-to-1 breaks the system. And the U.S. Mint says they can't help retail buyers once institutional scrambling begins. That's not a forecast. That's a countdown to the biggest silver squeeze since 2011, and it starts in exactly 3 weeks.